Let's take a look at problem 7-9. In this problem we have 4 different notes receivable, and the problem has asked us to prepare the long-term receivable section of Braddock's balance sheet at December 31st, 2017. Prepare a schedule showing the current portion of the long-term receivables and accrued interest receivable that would appear in the balance sheet at December 31st, 2017. And prepare a schedule showing interest revenue from the long-term receivables that would appear on Braddock's income statement for the year ended December 31st, 2017. So let's start at the top with the information presented. At December 31st, 2016, we have notes receivable from the sale of a division, $1.5 million, and a note receivable from an officer for $400,000. Transactions during 2017 and other information relating to Braddock's long-term receivables were as follows. So what we will do is we will work on 2016 and 17 information just so that we can see how these numbers come into 2017. That is only if the note was created in 2016 or earlier. So the first one says that the $1.5 million notes receivable is dated May 1st, 2016. It bears an interest of 9% and represents a balance of a consideration received from the sale of Braddock's electronics division to New York Company. The principal payments of $500,000 plus appropriate interest, which means on the outstanding balance, are due on May 1st, 2017, May 1st, 2018, and May 1st, 2019. The first principal and interest payment was made on May 1st, 2017. Collection of the notes receivable is reasonably assured. So we're going to do this as 4 separate receivables and finally see how to take the information forward. So in this case, let's start in 2016 on the date that the note was made. On May 1st, 2016, our journal entry would have been notes receivable debit for $1.5 million, and it would not be cash. We didn't give cash. We sold a division, so we'll just call it a division that has been sold for $1.5 million. All the assets of that division have been sold for $1.5 million. So what I'm going to do here on the side is I'm going to update my T account or post this information in T account, and I'm also going to show you the dates here on the side just so that we can be consistent. So I start out with the $1.5 million notes receivable being debited, and this happened on May 1st, 2016. At the end of the year, we're not getting anything by way of interest, nor are we going to get the first installment. That's going to happen on May 1st, 2017. But at December 31st, 2016, we do an accrual journal entry, interest receivable debit, interest revenue credit. At December 31st, 2016, the entire $1.5 million is owed to us. The interest rate is 9%, and we'll calculate the interest for a total of 8 months from May 1st through December 31st. So it's going to be $1.5 million times 9% times 8 over 12, which works out to $90,000. I post that information over here. Interest receivable debit, and that's on December 31st, and interest revenue credit, and again that's on December 31st. And now let's see the balance in these accounts. So at December 31st, my balance is still $1.5 million, and the balance over here is $90,000, and this is also $90,000 at December 31st. Now remember, I'm not interested in 2016 numbers, but these numbers come into 2017, and that's the reason I was interested. Which numbers are we concerned with? I'm concerned with this number and this number. The reason I'm concerned with these two and not the interest revenue from 2016 is because interest revenue is an income statement account. It's a temporary account. It's going to get closed at the end of the year. It's not going to transfer over into 2017. However, these two numbers are going to come into 2017. So let me take this information over here, and the 2017 I'm going to start the year. I'm going to highlight this. I'm going to start the year with the numbers that carry over from 2016. Now on May 1st, 2017, I'm going to get my first installment of $500,000 and I will get interest. So what we will do is, we'll do this in a couple steps. We'll first do the accrual entry for the remaining 4 months. If you recall, in the previous year in 2016, we accrued 8 months of interest. So the remaining 4 months of interest we will accrue now. And our journal entry is going to be interest receivable debit, interest revenue credit, 1.5 million times 9% times 4/12. Okay. I'm going to go ahead and post this information just so that I have it over here and I know where these numbers are coming from. Okay. Now, on the same date, the New York company is going to pay me the interest. How much interest are they going to pay me? They're going to pay me the full amount of 90 plus 45. I'm going to receive in cash. So my journal entry will be cash debit, interest receivable credit for 135. So what I accrued last year plus this year, the 4 months, the full 12 months interest they are paying. So I'm going to go ahead and do the posting of this 135,000 accounts receivable is credited. Let's write the date again here so we know which date it's coming in. Okay. The cash debit, I'm not writing that because I'm not interested in the cash account for this particular exercise. It is important obviously, but not for this exercise. What else is happening on May 1st? They're giving me $500,000. So my journal entry for that is going to be cash debit, notes receivable credit, $500,000. So I'm going to write the $500,000 over here. Okay. Now, what's the balance in my account? $1 million is the balance in my account at the end of this year. Okay. Now, December 31st, I need to do another journal entry. This journal entry is going to be similar to what I did December 31st of 2016. It's an accrual entry. Interest receivable debit, interest revenue credit. On what amount am I going to do this accrual entry? On the 1 million. Okay, the $1 million times 9% times, again, how many months? 8 months, 8/12. Okay, so $1 million, the $1 million that's there, times 9% times 8/12 is $60,000. Let's go ahead and post the information over here. The 60,000 interest receivable is debited here, and interest revenue is credited, and it happens on December 31st. Okay. I've already closed my notes receivable account. I know what my balance is. To find the balance over here, you add up the two sides and then they take the difference between the two sides, and that is going to be your ending balance. This is the number I'm interested in on December 31st. This is the number that carries over into my balance sheet. Okay, and what goes into the income statement? In the income statement, December 31st, the number I'm taking over for interest revenue is 105 for interest revenue goes into the income statement. Okay. Now, just for this one note receivable, the problem asked me the notes receivable, what's the total amount? I know it's $1 million at December 31st. How much of that is current and how much of that is long term? Anything due next year is current. So of the 1 million, I will get 500,000 next year. So that is going to be current. And the remaining $500,000 is long term. My total notes receivable is $1 million. Interest receivable, the number over here is $60,000. Interest revenue that goes into the income statement is $105,000. So once again, let's look at these numbers over here. The $1 million is notes receivable, $500,000 is current, $500,000 is long term. Interest receivable is $60,000. Obviously, all of that is current. Interest revenue is $105,000, and that's what's going to go into your income statement. So at this point, we have taken care of the first note. Let's move on and read the information on the next note and see how we're going to do it. So let me get to my second sheet that deals with the second notes receivable. So I have a $400,000 note receivable that is dated December 31st, 2016. It bears interest at 8% and is due on December 31st, 2019. The note is due from Sean May, president of Braddock Company, and is collateralized by 10,000 shares of Braddock's common stock. Interest is payable annually at December 31st, and all interest payments were paid on their due date through December 31st, 2017. The quoted market price of Braddock's common stock is $45 per share on December 31st, 2017. So they've given us lots of extra information, but that information does go into the balance sheet and the notes to the financial statement. It's not pertinent to us calculating the basic information we want. So in this problem, December 31st, the transaction was the company loaned $400,000 to an officer. So fairly straightforward. The journal entry is notes receivable debit, cash credit on December 31st. Okay, so no interest has accrued, nothing, because that's the last day in the year. All that we have is this notes receivable amount. This amount that we have over here, I bring that forward to 2017. Now, during 2017, at the end of the year, 8% interest was due, and they've told us interest was received. Now, this journal entry is significant only because I want to calculate the interest revenue. So my journal entry is interest receivable debit. Apologies, my journal entry over here is cash debit, interest revenue credit, and it's $400,000 times 8% for the full year, and that will be $32,000. This $32,000 is interest revenue. The full amount was received in cash, so interest receivable, I didn't even need to open this T account. I just have that over here to be consistent with the other exercises. So, what's the balance in the notes receivable? Was any of that paid to me this year? No. When is it going to be paid? December 31st, 2019. We've given him 3 years to repay the money. So nothing happened to this account. It stayed the way it is. Okay, so what are we concerned with now? These numbers that we have here. Let me just take a look over here for a quick second. I have the dates there to show you what dates they came in. Okay, let's look at this. Notes receivable. $400,000 is due to me. How much of it is long term? How much of it is current? The full amount is long term. There is no current because nothing is going to be paid to me next year. Interest receivable. Is there any interest owed to me at December 31st, 2017? The answer is no, zero. Nothing is owed to me. He paid up whatever had to be paid up. Next year, when the interest accrues, he's going to pay on December 31st. Interest revenue, it's a $32,000. So these numbers were fairly straightforward in this exercise. All we had to look at was this amount was loaned last year. This year the interest was paid. Nothing is outstanding except the note itself, and that's a long-term note. So this one is a relatively easy note receivable. So let's move on to the third one. So let's move on to the third sheet here. And let's see whether we need 2016 or not. We don't, because it starts in 2017. So I'm going to slide over here to come to 2017. Okay. On April 1st, 2017, Braddock sold a patent to Pennsylvania Company in exchange for a $100,000 zero-interest-bearing note due on April 1st, 2019. There is no established market price for the patent, and the note has no ready market value. The prevailing interest rate for the note of this type at April 1st, 2017, that's the date the note was made, is 12%. So what we would need to do is we need to find the present value of this 100,000, and we've been told the present value of a single sum for 2 periods, n equals 2, is 12%. At 12% is 0.797, and they've told us to use this factor. So they're basically telling us you don't have to look up the tables, they've given us a number. The patent had a carrying value of $40,000 at January 1st, 2017. And the amortization for the year ended December 31st, 2017 would have been $8,000. So there's several things happening over here. I have a note, I have a patent. I sold the patent on April 1st. So one of the first things we need to do is, on April 1st, let's calculate the book value of the patent. In order to do the calculate the book value of the patent, we need to amortize it. So the journal entry for that is amortization expense debit, patent credit. The amount of amortization is the $8,000, the amortization for the year, times 3/12, because this is April 1st, 3 months have passed. January, February, March. So 3 months of amortization is done. Okay, I need that only so that I know what the value of my patent is. Now the book value of my patent is 40 minus 3 is down to 38. Now on the same date, I have sold the patent. I sold the patent and I got a note receivable in exchange. This note receivable has a 0 interest, but the implicit interest rate is 12%. So we will calculate the discount on notes receivable. So $100,000 times 0.797 will give me 79,700. So let me write down a few numbers over here. The discount is 100,000 minus 79,700, which is 20,300. I need to take the patent off my books. The patent I know is 38,000. How do I know it's 38? It's 40,000 minus the 2,000 amortization, which basically means I sold the patent for a gain. Okay, once again, look at these two numbers, add them up. These two numbers add up to 79,700. That's 100,000 times 0.797. Okay, now that I have this information, let me plug some of the information in over here into my T accounts. I have $100,000 on April 1st. My discount on notes receivable is 20,300. Now at the end of the year, I'm not going to receive any money. However, this discount on notes receivable, I'm going to show that as interest revenue. So discount on notes receivable is a contra asset account. It has a normal credit balance. In order to write it off, I need to debit it. So in order to amortize it, not write it off. In order to amortize it, I need to debit it. So there are a couple different ways in which we can do this. And the easiest way would be the carrying value of the note, which is 100,000 minus the discount, that's a 79,700, times 12%, which is the market rate, times 1/2. And why would that be times 1/2? Because we have it for, times 9/12. That would be because we had it for a total of 9 months. So let's recap what we have over here. It's done somewhere here. Just a second. Okay, let me do one thing over here for you. Okay, so we have the $100,000 note receivable minus the discount that gives you the fair value of the note. So when I add these two numbers, I get 79,700. The interest rate is 12%. So I calculate 79,700 times 12% multiplied by 12%, and further I'll multiply that by 9 over 12 because I had it for 9 months. That's how I come up with the 7173. Okay, so discount on notes receivable is debit, so I will debit that amount. Interest revenue is credit, so I credit the amount here. And now let's see what the balances are in each of these accounts. Again, let me write the date so that we have that. The notes receivable amount stayed the same. Nothing happened over there. The discount on notes receivable decreased. Remember, the goal is the discount on notes receivable is going to decrease and become zero eventually. The interest revenue, we have only one entry, so we have this number over here. Okay, so I'm going to go back over here for a second. So this is and let me increase the font size so you can see it properly here. We have notes receivable, and this is less the discount on notes receivable. Okay, the notes receivable balance stayed the same. Nothing happened to it. At the end of the year, at the end of the year, the amount dropped to, and I'm putting that in parentheses, to 13,127. So what happens to the balance in the notes receivable account? Again, I need to calculate the balance, and this is the balance. Okay, so why was this important over here, this calculation? Because when we do this, answer the question finally in the for the problem, your notes receivable is going to be this number. Notes receivable less discount. The net amount is what goes into the balance sheet. So that's the number we need. Is there any interest receivable? Okay, there is no interest receivable. Is there any interest revenue? Yes, there is the interest revenue here. Okay, so these things that I have, notes receivable current, there's nothing current. Remember, when is the entire 100,000 coming to me? It's coming to me on April 1st, 2019, which is past the 2018 mark. So it's a long term. The entire amount is long term. But what I'm presenting is only the net number. The net number is notes receivable minus discount on notes receivable. That's a number that goes into the balance sheet. Okay, let's finally move on to the last notes receivable. On July 1st, 2017, Braddock sold a parcel of land to Splinter Company for $200,000 under an installment sales contract. Splinter made a $60,000 cash down payment on July 1st, 2017 and signed a 4-year 11% note for $140,000 balance. So the 200 minus 60 is 140. The equal annual payments of principal and interest will be $45,125. That's going to be payable 1 year from the date of the note, which is going to be July 1st, 2018, and it's going to go through July 1st, 2021. The land could have been sold at an established cash price of $200,000. The cost of the land is $150,000. Okay, so now let's move on to the fourth note. Again, all of this happened in 2017, so I don't need 2016. Let me go to the 2017, and let's start with our first transaction. We sold the land and we got a note receivable. So note receivable debit. Okay. I also received cash. How much cash did I receive? $60,000. The note receivable is for $140. Land in my books was $150. That was a cost, which means I have a gain in this transaction of $50,000. The only piece of information that's relevant for our problem right now is this $140,000. So we didn't need to do this journal entry, but again, I'd like to show you where I'm getting the numbers in my T account. December 31st, 2017. I'm not getting any cash. I'm not getting any interest. I'm not getting the first installment. That's going to happen on July 1st, 2018. So what do I do on this day? Accrual of interest. Interest revenue, receivable debit, interest revenue credit. Okay, so this is fairly straightforward. I have $140,000. The interest rate is 11%. So 140 times 11%. How many months did I have the note for? 6 months. So times 6/12. Okay. So 140 times 11% times 6/12 will give me 7,700. So my journal entry, when I post it, I have interest revenue of 7,700, and that's going to be your balance. There's nothing else over here. Interest revenue, you have a credit of 7,700, and that's going to be your balance over here. Now, a couple things to keep in mind over here. Principal plus interest is 45,125. How do I know that? Because that was told to me in the problem. Okay? This is going to happen on, this payment is going to be received on July 1st, 2018. So the interest calculation which I did over here for 6 months, on the due date you will get the interest for 12 months. Okay, so let's see what that number is going to play out to. Interest will be 140 times 11% for the full year. So I don't need to do any partial calculation. It's basically this 7,700 times 2. This was for 6 months, so this will be for the full year. Okay, now principal plus interest equals 45,125. Let's put that back in this over here. So principal is going to be 45,125 minus 15,400. Okay. Why is this significant? This is significant because I need this last piece of information over here, the principal repaid, because that's what's going to appear in my balance sheet, and we'll see what we're going to do over here. I have notes receivable. A part of it is long term, a part of it is current. I have interest receivable, that's current. I know that number, 7,700. I know how much goes into the income statement, that's easy. I need to calculate the current and long term portion. So the current portion is this number that we had over here, this 29,725. That's the current portion, which means the remainder is long term. So when you add up these two numbers, you will get the $140,000. So that 140, the calculation of long term and current is done as follows. Go back, recap over here. The total principal plus interest is 45,125. We know the interest is 15,400. Therefore, the principal that will be paid next year is 29,000. Let me put the comma in the correct spot. Is 29,725. That portion that will be due next year is current. Everything else is long term. Hope this helps in terms of working through this problem 7-9.